Good afternoon. I'm Chris Swift. On behalf of my partner, Chris Winward, and our sales assistant, Sean Gammon, thank you for taking this time to be with us on this afternoon Shooting the Bull. Today, we're going to talk about soybean producers and how that through greed, fear, and courage, we might be able to market beans at a higher price. So this is what I look at. I look at the November soybeans, and here is a monthly chart on the soybeans, and we can see multiple times markets rallied, multiple times the market has gone down, and we know that this is probably going to happen in the year of 2024 as well. So when it does happen, let's say beans go to $15, $16. We don't know if they will, but if they do, we can be pretty much assured that there is something transpiring out there that we did not know about, and it increases our greed factor of wanting more, or fear factor, potentially losing what we have already made. So how can we protect against that or build some kind of courage in us that if those prices are achieved, we can take advantage of them? So let's take a look at a little strategy. Here's the November of 24 soybean contract. We've got approximately 9 to 12 months to market this product in. So if we come in here and say that, beans go to $13, $14, they've kind of already been to $13.50, but where we want to really market at is if they get up into the 15, 16 area. That's where we'd really like to have the courage or the confidence to be able to make cash sales and still not be either hung out wanting either more for it or fearful that we're not going to make it. So what do? We go in and we look at the November 12 at $12.73 has a contract value of $63,650. The $14 calls are 44 cents. They'll cost you $2,200 or 3.4% value of the contract. You buy the 15 calls at 27 or the 16 calls at 17. And what does this do for you? Now you can be long beans today with the 15, 14, 15, or $16 strike costing you one of those premiums. Whatever happens, I don't care. It's a South American issue. It's a U.S. issue. It is an energy issue for which beans are moving higher simply because of the energy aspect to them. I don't care. But when they get to $15, whatever that reason is going to be boiling hot. And myself, you, and every analyst on RFD TV is going to be talking about it, and you're going to be wondering what to do. So you already own those calls. Those calls will have increased in value, and you go in and let's just assume that we're at $15. You make a cash sale at $15, and you wonder, am I going to lose out on more, or was that the best? It doesn't matter. If the market goes down, you lose open position equity in the option, and you may even lose the premium that you paid, but you just marketed cash beans at $15. If it goes to $18, which we've never seen before, I think $17.94 is like the all-time high, but it goes to $17.94, your option continues to increase in value. Even though you've marketed cash beans at $15, we're at $17.94. That option is worth another $2.94. You can cash out of it at any time you want to. The downside of this is if I'm dead wrong and beans don't have any kind of rally to them whatsoever all year in the next 12 months, you're going to lose 25 cents and you're going to have to market beans at whatever the available price is. You never had the opportunity to begin with. So we gave away 25 cents, 27 cents, whatever premium costs that you're going to be looking at, that's what you're at risk at. This is not to try to hedge beans at the lower prices in fear that it's going to go down. If you're into that, then go ahead and make those trades. This particular trade is to help those individuals that want to make quite a bit of money when they see higher prices, but maybe sometimes have a little bit less courage or knowledge not to know that they can do strategies like this. So if or when beans make a move higher, I can now sell the cash product with no fear. I can't lose anything. I've just marketed my beans. I could lose open position equity in the option, might even lose the whole premium, the 27 cents I paid for it, but I still sold beans at $15 a bushel or whatever that price is. So you're a soybean farmer, you're looking out into next year, you've already harvested this year's crop, 49.6 bushels per acre, and you say to yourself, wow, the market is probably going to fight tooth and nail this year to try, or excuse me, in 24 to try to attract more acres into beans. Therein lies a little bit of an undertone to the bean market there. And then again, if anything does happen, it gives you the opportunity to market those beans courageously without having the fear or the greed factor in there that might keep you from making those very, very crucial decisions. So take a moment to review this, look it over, ask other people what they think about it, and then Monday morning, give us a ring and see what you think about it. I certainly appreciate you taking the time to listen to me. I'm Chris Swift with Shooting the Bull and Swift Trading. Have a great weekend.